Welcome to today's lesson on emergency funds, one of the most crucial foundations of personal finance. An emergency fund serves as your financial safety net, protecting you when life throws unexpected challenges your way. Think of it as a financial cushion that stands between you and potential debt or financial hardship. Today, you'll learn exactly what an emergency fund is, why it's absolutely essential for your financial well-being, and most importantly, how much money you should save to build this critical safety net. An emergency fund is simply a dedicated savings account specifically set aside for unexpected expenses that could disrupt your financial stability. This isn't money for vacations, shopping, or planned purchases. Instead, it's your financial insurance policy against life's surprises. The key word here is dedicated. This money should be kept separate from your regular spending money and only touched when a true emergency occurs. It's liquid money that you can access quickly, without penalties or waiting periods. Let's look at some real-world situations where an emergency fund becomes invaluable. Medical emergencies are among the most common and expensive surprises. Think unexpected hospital bills, urgent medical procedures, or sudden health issues that insurance doesn't fully cover. Job loss is another major emergency that can happen to anyone, regardless of industry or experience level. When you lose your income suddenly, having an emergency fund gives you breathing room to find new employment without immediately falling behind on bills or going into debt. Emergency funds also cover major car repairs when your vehicle breaks down unexpectedly or gets damaged in an accident. Since many people depend on their cars for work and daily life, these repairs can't wait. Home repairs represent another category of emergencies, from roof leaks and plumbing disasters to appliance failures and heating system breakdowns. These situations often require immediate attention and can cost thousands of dollars. Without an emergency fund, people often resort to credit cards or loans, creating debt that can take years to pay off. The primary benefit of having an emergency fund is avoiding high-interest debt from credit cards. When emergencies strike and you don't have cash available, you're forced to put expenses on credit cards, which typically charge interest rates of 20 to 30% annually. This turns a temporary emergency into a long-term financial burden. Additionally, having an emergency fund significantly reduces financial stress during already difficult times. When you know you have money set aside for emergencies, you can face unexpected challenges with confidence rather than panic. Financial experts recommend saving 3 to 6 months of your monthly expenses in your emergency fund. Notice that this is based on your expenses, not your income. The amount you need depends on your monthly essential costs like rent or mortgage payments, utilities, food, transportation, insurance, and minimum debt payments. This range gives you enough cushion to handle most emergencies without depleting your savings completely. The higher end of 6 months is recommended for those with less stable income or higher financial responsibilities. Here's a simple example to help you calculate your target emergency fund amount. If your essential monthly expenses total $3,000, you would multiply this by 6 months to get $18,000 as your emergency fund goal. This includes all your necessary expenses: housing, utilities, groceries, transportation, insurance premiums, and minimum debt payments. Don't include discretionary spending like entertainment, dining out, or shopping in this calculation, since you would cut these expenses during an emergency. Starting your emergency fund doesn't have to be overwhelming. Begin small. Even $500 is infinitely better than having nothing saved for emergencies. This initial amount can handle smaller unexpected expenses and gives you a foundation to build upon. The key is to keep your emergency fund completely separate from your regular checking account. This separation prevents you from accidentally spending emergency money on non-emergencies and makes it easier to track your progress toward your savings goal.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.